You're listening to the Real Estate Runway podcast, powered by Quattro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, Real Estate Runway family, welcome to another episode of the Real Estate Runway podcast. I am your same old host, Chad Sutton with Quattro Capital, and I'm joined today with two Canadian friends of mine who are much better looking than I am on camera. Just look at this. I'm in my gym clothes, and they are in this beautiful getup here. Ava Benesocky and August Biniaz. The two of them joined forces in 2019, realizing the pain points that Canadian investors are facing in both of their fields of expertise. They founded a firm called CPI Capital. Now, CPI is a Canadian-based real estate investment firm in the business of discovering, acquiring, improving, and actively managing US multifamily rental value add real estate assets. Now, I'm really excited to get into this because they're going to bring a new flavor of why Canadian money is coming to the US to invest instead of in Canada, and how you can do that too if you are a Canadian investor. So without further ado, Ava, August,
thanks for having
welcome
us
to the show.
On today,
so
Chad.
happy to have you here. How are you today?
And we're excited to see you again. Always nice to see you, and thanks for having us.
Absolutely. Good to see you both as well. So what I'd love to do first is, maybe we'll lead off with ladies first, because that's the gentleman thing to do, August. So maybe we can hear about the two of you and kind of how you got into real estate, where you've been, and what got you to the point to start CPI Capital. And then we'll get into why Canadian investors are finding value in the US markets.
Thank you for ladies first.
And how they can do that. What do you think?
Ava Benesocky here. I'm CEO and co-founder of CPI Capital. And I helped many real estate investors over the years. I've been a real estate professional for about a decade now. And about 2 years ago, I fell in love with US multifamily, particularly because of all the benefits that lie behind it. So for the last 2 years, I've been waking up every day, educating my fellow Canadians on how they can invest in US multifamily, create passive income for them and their families, and really create a life on their own terms. So it's an exciting world we're in.
Absolutely. Yeah, great. I'm August Biniaz, co-founder of CPI Capital. Been in real estate in one form or other for past 16 years, starting out as a licensed agent. Wasn't really good at being an agent, but I was good at finding deals. Started doing small fix and flips, started my own general contracting company, built single family homes, more on the luxury side, and eventually scaled up to do ground up multifamily development, townhomes as we call it over here. There's a lot of pain points that existed in ground up development. It's made to sound very glamorous being a developer, but there's a lot of issues that exist. The long timelines that exist here in Canada. You start out doing performance on a project, and by the time you're midway through, everything changes because our market is very much dependent on foreign investors here in Canada. Issues with the city. It's not really business friendly, government that we have in every different level. So pretty hard getting projects rezoned, and then also issues where, at the time of, ground up development has issues because you have to go through the city with rezoning. Then you have to deal with, possible environmental issues. Then you got, dealing with contractors and the construction process, labor costs and material costs. So when I was introduced to US multifamily value add, I fell in love with it because it's an already built asset. So you're just going in there and adding some sort of value, but also I realized this concept of syndication, where I had in the past syndicated deal, but I didn't really know what a syndication was. So when we realized that and we saw the potential that exists, particularly with Canadian investors, because the median home price being between $1 million and 1.3 in Vancouver and Toronto, the largest cities, and a median income is at 90,000. It's very hard for most people to buy their primary resident, let alone to become real estate investors. And a lot of message and content comes from US side where it said, hey, invest in real estate, buy real estate, but it's very difficult for people to do so. So we realized that issue, and we found a way that we could solve it and also provide cash flow and appreciation to the investors. So we started CPI Capital, and that's where we are at today.
Yeah.
Sounds like you're really solving a missing niche in Canada right now, because I think from previous conversations, there's really not a lot of opportunity for Canadians to participate in
There,
some
there,
of these
there, there
larger real
definitely
estate
are
projects?
opportunities.
What,
There's
what
the
seems to be
larger
the
ground-up
problem there?
development projects where the developer brings on investors, but there is no form of cash flow, and these investments are long-term, 10 years in some cases. And because of the low rental yields here in Canada, there is no cash flow. Most properties are in negative cash flow. So when we realized the higher rental yields that exist in the U.S., obviously we fell in love with it, because if you can offer your investors, distributions, monthly distributions in some cases, then it's a lot easier offering.
Then it's a win. And not to mention multifamily here, we're looking at 1% to 2% cap rates. So if anybody knows how to determine the value of an asset and to really create a wealth building machine, it's very difficult to do so with cap rate compression that we see here.
That's very interesting. And fortunately or unfortunately, depending how you look at it, we are in a time of severe cap rate compression here in the US. It is, over the last 10 years, it has compressed a lot. And many of the industry experts are believing it will continue to compress because the fundamental supply and demand issue is still there. There just is more and more and more capital, including our friends in Canada, looking to assets this way. So we may be approaching that, but that means it's a great time to be investing in it while it's going there. So that's hard to fathom a 1%,
Yes,
1-2%
no, and in my
cap
conversation
rate,
with many brokers, I asked the question, I'm like, how are you able to sell a multifamily project at a 2% or even a 3% cap rate? What is the reasoning for someone buying that? And the answer over and over is capital preservations. And also is investment culture is different in Canada and the US. Canadians invest differently than our American friends. If an investment doesn't really make sense, Americans are not going to buy it or not going to invest into it. Whereas here in Canada, we've relied on continuous appreciation for so long, which is not sustainable. But because of the huge immigration that we have into Canada, 300,000 people every year immigrate to Canada. Most of them want to live in Vancouver and Toronto, the major cities. So we have that demand that exists. But this idea that this is going to be sustainable, it's somewhat of a fallacy.
So it seems like the problem in Canadian real estate is the asset prices have already caught up and surpassed the, we'll call it, intrinsic value that an investor would be looking for. And the only I guess you really can't even leverage a 1% to 2% cap rate, right? You're really looking at buyers who I assume
exactly they're just playing the appreciation game.
Yeah, and in a result, it's a result of negative cash flow on every deal. So the two main components as a real estate investor that you're looking for just doesn't add up here.
That makes sense. That makes sense. Well, tell us how you solve the problem of, helping your fellow Canadians invest in these value add multifamily projects, not your development counterparts where it's more of a long-term appreciation play, but it seems like you're really trying to solve the problem of cash flow, maybe tax benefits and appreciation at the same time in an area where cap rates still have room to compress.
Right? I mean, so everything started out with us seeing the opportunities that existed in the US, comparing the opportunities in the US with Canadian opportunities. And we're like, this is a no-brainer. We have to be in the US. And when we first started researching and we realized that there are billions of Canadian dollars being invested in the US on the institutional side. You have the Canadian Pension Fund partnering with Greystar to buy and build multifamily projects. So that was already taking place. And say, how do we do this on the retail level? How do we allow everyday individuals to be able to invest passively as limited partners and be relieved from double taxation, which is a main concern? So we happen to have a treaty with the US. Yes, we have a treaty with Canada, has a treaty with the US. The US actually has treaty with many different countries. Countries around the world have treaties. We're experienced and have an understanding of the treaty, particularly between Canada and the US, which allows for relief from double taxation as long as the structure used is the right structure, which allows for relief from double taxation. So, for example, the CRA, Canada Revenue Agency, does not see LLC as a flow-through entity and is taxed at is taxed at it's double tax. It sees any kind of revenues made from LLC as distributions, as dividends, and then they're taxed on the U.S. side, and then they're also taxed when those funds are repatriated. So that it was about to put the structure in place to allow our investor partners to invest with us.
Yeah, and to show up 100% passively, not having to worry about all the entities needed to be created, not having to worry about converting the scary forms from the K1 to the Canadian version, which is a T5013. So we take care of all of that for our investors. When people think of real estate, I want to highlight passively because it's streamlined for the investor, right? A lot of busy professionals and a lot of people, they don't have the time to worry about, first of all, to worry about where to invest, and then how to manage it, and then what should I do as far as renovations. So we've made it really streamlined for Canadian investors. But just to take it a step above, we're bringing them diamonds in the rough from the US that they have at the fingertips here to receive those above market returns that are really exciting, and that cash flow. Cash is king, right?
Absolutely. That's fantastic. So you've really solved the problem of looking across borders. I mean, I can imagine buying a property myself out of country and trying to figure out how to manage it, making sure that I'm in compliance with laws of another country, much less my own, and then the conversion between that's always a scary thing. So I didn't. What did you say that form was?
Your version of a Schedule K1.
T35013.
There's all this kind of red tape and unknown for Canadian investors, but we're like, the opportunity is so incredible that we're like, let's streamline this so that it kind of just puts everybody at ease.
Yeah. Well, you're in a very unique position because, there's probably not a whole lot of groups doing what you're doing in Canada and I guess migrating money to the US to invest in these assets. In some cases, I think you've mentioned that you will actively manage the properties, but you also would partner with people on the ground in the US to do it. So, how do you select your partners? How do you select the market, being abroad in Canada? Like, what's your process for it on behalf of the investor for figuring out where do I invest?
Yeah,
who do I invest with?
With us, it starts with the region, obviously, United States because of the returns that are available, but also the markets within the U.S. So as I'm sure you're well aware of this, there's the interstate migration happening within the U.S. People are moving from these high tax and high cost of living states into lower cost of living and lower tax states. We just follow the numbers. So as long as there's consistent job growth, population growth, income growth, rent growth, growth metrics available in the market, and crime reduction.
Yeah, don't forget the crime reduction.
These are great markets to invest in. Also, it goes back also to kind of the investor profile as well. We're in the west coast of Canada, so a lot of our investors who are from the west coast are familiar with Arizona, Texas. They've either traveled there or they possibly own a winter home there. So when we do bring in our offerings in those regions, or we're looking at those regions, they're much more inclined to be interested. And then our East Coast investors are familiar with Florida, maybe not so much in North and South Carolina, but it's becoming much more common. We have an asset in South Carolina, in Charleston. So that's how we go about as far as selecting a region. As far as the operator, again, we need to have boots on the ground. At some point, we are planning to create our own infrastructure in the states we want to be in, possibly in Arizona, Texas, and Florida, and South Carolina, to have our physical office or have an asset manager in place. But currently, it is basically finding the right operator to partner with. And we are very much involved in the space. We watch it very closely. We're connected with many other operators in the space through LinkedIn and many other events and seminars and webinars. So we know about superstar teams that have done Quattro Capital, who have done so tremendously well in the space and have had such a tremendous growth. And Americans are also very business minded. They're very entrepreneurial. So in my experience as being in the Canadian real estate space, you give a call to a developer or larger developer, sometimes you don't even get your phone call answered, whereas Americans are much more open to discuss. They're much more open to kind of pursue and entertain the idea of co-syndication to team up and do projects. So so it goes on the performance of the operator, how well they've done, what is the kind of feedback that investors who've invested with them in the past, and having the right team in place and partnering with them and taking down these large deals that most times would be very difficult or near impossible for smaller groups or individuals to get involved with.
Very good, very good. And so, Ava, I know you have mentioned on multiple occasions that what's the right way to phrase this? Americans are a little bit more crazy in their real estate investment decisions than Canadians. Canadians are typically more conservative, right? And so, as we've mentioned just on this call, I mean, I know you guys have also partnered with our friends at passiveinvesting.com, for example. They're another wonderful operator who we know very well, who are very decorated and had a lot of success in the space. You know, their strategy is more of like the high-end Class A luxury product. You know, they'll buy at a lower cap rate, but look, they're not buying for, they'll have value add, but they're not going to be really steep value add. They're really more playing the cap rate play with a newer, nicer asset. And that's their strategy. Whereas someone like a Quattro Capital or other operators would be looking for little older buildings, you know, things maybe built in the, I don't know, let's say 80s or 90s. And the value add creation might be much higher, but the cap rate may also be higher as well. So, you know, you kind of balance out your risk versus reward there. And per usual or per your typical strategy, here comes the question finally, after I say all that. What are you guys really looking for? Is your investment base more interested in that luxury product and a little less risk, a little less return? Or are they more interested in maybe that middle of the road equity creation there, which is a little more risk, but a little higher return typical? What are your people looking for? What are you doing rather?
To be honest with you, right? We've shown them a couple of the newer projects as well, but keeping in mind, we've created really strong relationships with our investors, and we've educated them about this value add opportunity component as well. So we brought newer assets to the table, and you know what, to be honest with you, in Canada with returns, usually Canadians are happy with a 5 to 6% annualized return. So whether
this is in non-real estate products though.
Non-real estate products though.
And no cash flow. I mean,
no cash flow.
Just to add to that, I mean, it goes, what we advertise ourselves in and the products we invest in is products that are, have the potential of providing cash flow from day one. And some deep value add projects, there's not availability for cash flow because the project has to be stabilized, has to has to be brought up to rent, have to be brought up to market, or certain units have to be renovated. So there might be no cash flow. So there's really a balance, right? So it's a balance that has to be kind of, the decision has to be made. Hey, do I want to have cash flow from day one and invest in a Class A asset, or do I want to have it, the deep value add where the potential for returns are much higher, but also I might not have cash flow for the beginning. So they're just two different investment strategies, very close to each other, not night and day different. But and that's kind of our job as well, right? As the stewards of our investors, as fund managers, we have to make that decision. What makes the most sense in the current market, and also the deals that come our way from different operators that we work with. What is the deal that currently makes the most sense? So I guess we are within that space. So as long as it's a B class, C class asset with a value add component, or a new or A class asset like passive investing does, we're comfortable playing in that space.
Yeah, very good. So it really sounds like you can play in both of those spaces depending on the investor appetite at the time. We're kind of coming to the end of our time here, but what I'd love to do is really just hear from you as a summary. Why would I, as a Canadian investor, choose to take my money and go to US real estate versus Canadian real estate?
Frankly, it's the simplest summarization.
Condense all this and summarize real quick.
If you can invest in Canada and receive cash flow from day one, and be able to have natural appreciation, high chances for natural appreciation because the market has job growth and population growth, then you're in a good place. If you're cash flow in a market that has had same population for the last 10 years, okay, great, you get some cash flow, but there's probably going to be no appreciation. But if you got appreciation and cash flow, that's the best deal. And if there was such deals in Canada here, we would be investing in them. We wouldn't have to go through all the we have to go through to invest in the US and all the difficulties. So unfortunately, there isn't. And that's why, the US investments are just night and day. As long as we get on a call with an investor who has some level of sophistication with investing, as soon as they see the returns, to a point that we've had to lower some of our returns, where our advisors are like, hey, these returns, the Canadians are used to the 4%, 5%. You're talking to 20% annual return.
Sounds a little too good to be true.
It sounds a little too good to be true. Let's bring those returns. Like, hey, that's within our performance. That's what we're, you're showing. We're not amplifying the returns, but they're like, hey, let's bring the returns on, so it, looks a little bit more realistic to the Canadian investors.
And then you're a hero when you show up with 20+%, right? So it's very good. Very good. Well, fantastic. All right. Before I let the two of you go, you have to go through the Quattro Trio. All right. 3 questions we like to ask everyone on the show. So first of all, and I'll ask, I think I'm going to go to Ava first and then August. So we'll kind of bounce back and forth with both of these. What is your superpower in this business?
Strong relationships with people.
I would believe that. I think you and I have spoken 3 or 4 times.
My superpower, let me think, being creative, being creative and open-minded.
August, what about you?
Exploring and pursuing new ideas and new concepts.
Fantastic. Now, we've heard all the reasons you're credible. We've heard all of the success you've been having and all the amazing things about CPI, but give me some dirt. What is your biggest failure to date?
Possibly.
And what did it teach you? It could be in life or business.
What I need to focus on. Yeah, that's probably my biggest failure.
That's great. Biggest failure to today, hiring the wrong man for the job.
You're slow, fire fast.
And perhaps not firing quick enough, right? Yes, that people say that it's harder to make yourself do it, but you're right. Be slow to hire and quick to fire, unfortunately. Okay, and I believe you guys are published authors. So what have you written, and where can the listeners find it? And I guess that is
Ordinary to Extraordinary. 10 women across Canada came together to tell their real estate investing stories and how they achieve success through real estate investing. So we really get genuine and we tell our ups and downs, and the whole purpose is to really motivate other women to if I can do it, you can too. So take control of your life and put systems in place and become successful.
Yeah. And if you're watching or listening to this show and you want a copy of that book, get in touch with us and we'll send you a copy on the house.
Absolutely. Please do. Yeah, reach out.
Fantastic. And folks, for those of you who are driving, don't worry. Their email or contact information will be in the show notes. Just scroll down when you get where you're going and you can contact them that way. All right. Final question. At Quattro Capital, one of our 4 pillars is philanthropy. So we always want to make sure we give our guests an opportunity to promote a philanthropy or a philanthropic venture that our listeners can support on your behalf. So where are you
currently? I mean, we're in communications with a bunch of different charities, BC Children's Hospital being one of them. But also, we feel like where we're giving a lot back is with coaching calls and mentoring calls that are non-monetized currently that we're having. I have a bunch of pupils, if you may call them, that are on calls with me. So again, if you're listening to this show and you want some direction, or if you want, some advice, I'll be more than happy to give you 30 minutes of my time. So get in touch with me and I'll do that.
Yeah. And I'm having a lot of calls with women, just trying to get them to take charge of their financial futures, to be in control. So if you're listening, I would love to get on a call with you guys and kind of help guide you to get started.
Fantastic. Now I'll let you say it here, and again, it will be in the show notes.
You can email me. I love LinkedIn, so Ava Benesocky on LinkedIn, or you can reach me at ava@cpicapital.ca.
Fantastic. All right. Well, thank you so much for being on the show. Friends and family, this has been another episode of the Real Estate Runway podcast. And until next time, over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway podcast.